Welcome to The Explainer. Today we're breaking down how armed conflict completely upends the global economy.
Okay, so what happens when things go from calm to chaos? Let's start with how markets usually work. In peacetime, economies often follow a pretty predictable pattern, kind of like the seasons: expansion, peak, contraction, and recovery. You see, this whole system is built on a big assumption that things will stay stable and connected.
A key part of this is something called just-in-time supply chains. They're all about maximum efficiency. But then conflict hits. It's a sudden, violent shock to that carefully balanced system, and the effects are immediate.
The first reaction, usually it's panic. Investors dump risky stuff and run to so-called safe havens like gold.
And here's the switch. That peacetime efficiency, it suddenly becomes a massive vulnerability when war breaks out. Okay, let's move on to the deeper, long-term economic scars, which can linger for years. Get this. In a bad conflict, a nation's GDP can plummet by 30% in just 5 years. And real investment, the money needed for future growth, it dries up, falling by an average of 13%. Meanwhile, inflation goes wild. Consumer prices can soar by an average of 62% over a decade.
The bottom line, this painful contraction hits pretty much everything, from credit all the way to trade.
But here's where it gets really interesting. Not all conflicts or their recoveries are the same.
For instance, studies show that civil wars actually cause way more lasting economic damage than wars between nations.
Things like a country's income level, who won the war, and its financial health all play a huge role.
So what's the key takeaway from all this? Well, it's about the need for economic resilience. That means diversifying supply chains, boosting domestic production, and having adaptive government policies ready to go.
Understanding these dynamics is how we can prepare for the ripples conflict sends across our interconnected world.